Well, today we're joined on Good Day NWA by investment advisor Tony Hansman from Guardian Financial to break down how the sequence of returns can impact your retirement savings, both with and without withdrawals. Welcome, Tony.
Hey.
Thanks for having me. I appreciate it.
Absolutely. Let's talk a little bit about, we were kind of catching up before we came on, and you were telling me the differences in kind of like investing and retirement when you're young as opposed to when you get older. So fill us in on that.
Yeah, so there's, when we're younger, 30s, 40s, and 50s, we call that the accumulation phase, right? We put the pedal to the metal, we try to get as big as growth as we possibly can. But when we get into our upper 50s and 60s, that's a shift. Now we're going into the preservation stage, and most clients, or most people in general, are getting only one step, and that's just stocks, bonds, mutual funds, in investment side. And there's really 5 other really important stages that they should be looking at.
Okay, yeah. Well, let's kind of break that down a little bit. What are those 5 stages?
Sure. So one would be the income, right?
Okay.
Nobody wants to run out of money, right? And then be a burden on loved ones. Okay. So 2 would be investments. We want the greatest returns with the least amount of risk and the lowest cost. And then taxes. Nobody's getting help with taxes. And it's usually one of the biggest problems that people have. And so by the time I see them in their 60s, they've done a great job of saving, but they've got this huge tax problem, right? They're always helping with, right? And so then we want to talk about long-term care because it's one of the biggest reasons a plan falls apart. And then you want to wrap it up with all of your wills and trust and all those important documents. Like those are the 5 important phases as you're in or nearing retirement.
Yeah. Can we talk about maybe that sequence of returns? We were talking about withdrawals and then without withdrawals and all of that. What can you fill us in?
Yeah, so think about like a 20-year period. So from like 2000 to 2020, okay? No matter what the returns were, if you flip those years backwards, I think we got a chart up here, and you start with 2020 and you end it with 2000, it doesn't matter the sequence of returns if you didn't take a withdrawal, okay? You get the same rate of return, you got the same balance, no big deal. However, when you get into your preservation stage of life, and now we got to start taking income from it to live off of, right? So if those first couple of years in retirement, the market's down, and you're pulling money out, that can be devastating to a portfolio.
Okay.
So we talk to people about having multiple buckets. A growth bucket, right? So we can keep growing it for the long term, but then some other safe money that when the market's down, we can go to, take money from that account, and allow the growth bucket to rebound and bounce back.
Okay.
Does that make sense?
It does. Because you're talking about in a down year, you don't necessarily want to be withdrawing.
That's
from
right.
your
So the
account,
market's down 20%, you go pull out another 5, now you're down 25%, and people think you only need a 25% return to get back to even. Well, that's not true.
Right.
So you need a bigger return, and we don't want to take greater risk when we're in retirement. We want preservation, and we want to be safer with our money.
Yeah.
Right. So what kind of strategies can people do to protect retirees from early negative returns?
Well, first of all, is be aware of it. You know, getting with your advisor. We're fiduciary responsibility, so we're meeting with our clients often and just monitoring the market. Nobody can predict what the market's going to do, right? Okay. So since we don't know what it's going to do, we're getting together often and say, okay, the market's down and you're pulling X amount of dollars out. Let's just shift that. Let's stop doing that and bleeding that account and go somewhere else. CDs, high yield savings account, maybe some fixed index annuities.
A little more stability there.
Exactly. Okay. And then that allows time for that growth account to bounce back. If you're not doing that, though, you can see on these graphs that we provide you guys, money can run out a heck of a lot faster, and we don't want to do that because it is, public speaking is people's biggest fear when they're younger, and then income planning is their biggest fear in their 50s and 60s. That's right. So that's why you have to make income planning proactive and be ready to be actively making changes as the market happens to us.
That's fascinating. That's a great tip, I think.
Absolutely.
Fun, right?
Yeah, how can folks reach out to you? I think is the main question.
So they can reach out to, my name's Tony Hansman, so they can just Google the name. We got a great YouTube channel out there. We're always providing weekly content with new stuff. They can call us at 479-268-4463 or just guardianfinancialinc.com.
Okay, yeah, hit them on the website, reach out. Tony, thanks for joining us.
Yeah, thank you so much for having me.
Yeah, very enlightening. Hope to have you back to talk about money again in the future.
Definitely.
For sure, yes.